What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be taking a look at Hershey stock because the last couple months, this stock is down nearly 13%. And last week, they reported a miss on their earnings as well for revenue, and then their margin is also decreasing. Now, some of the good news, though, well, I guess it could be good news or bad news, but I think it's good news, is that they are expanding their portfolio with the acquisition of sour strips. So I think that should be a good thing for the company. If we're looking at these companies' financials, right away, when I looked at the revenue and the income, I immediately liked it because this company is consistent, and that's what I like, consistency. So for the last 5 to 10 years, the company has grown 4 to 7%, which is not a lot, right? But it's consistent, and that's what I like to see because then I know we're not going to have any huge drops in the stock price. And that's why you see that in the last 5 years. I guess you could say 2023, there was a huge drop in the stock price, but that's because it got at a ridiculous valuation, right? It was trading at 29, 30 times earnings. So you can kind of see that once the P ratio gets that high, you can kind of see that it's like, okay, it's due to come down. So PE wise, the company is at a great valuation. It's at 19, 20 times earnings right now, which is normally a lot cheaper than where it's been at anywhere in the EPS dropping, expected to drop next year. Okay, so that's a little bit of a problem. Remember, the margins are coming down. Revenue growth is only at 1 to 3% for the next year or two, which is not great. That's actually less than what they've been doing the last 5 to 10 years, but still, this is not a growth company. We're looking for a consistent company, and maybe we're looking for a strong dividend, right? This dividend is 3%. And next year, when rates are down, well, this is going to be a better contender for people's investments because the yield's probably going to be higher than a lot of other options out there. So that's revenue. Then we get into net income, and we're looking at last year, $1.8 billion in net income. Keep in mind, this is a $35 billion company. So not super cheap, but again, the net income is consistent, and these growth numbers are actually much better. 8 to 10% growth on average the last 5 to 10 years. So that's what I like to see. Now, here is one of the biggest problems, the balance sheet. 3.6, actually, let's do this. Let's go to the more recent number of this. They have close to $4 billion of debt. Remember, they're making almost $2 billion in net income, and they have not that much cash on hand, right? So they have, watch, okay, the equity has gone up. That's the good part, right? The equity has gone from 2.2 billion to 4 billion. That's a nice jump there. However, if we take a look at their debt, let's just say, okay, let's just do this. How much do they have in current assets? 3.5 billion. Cash is only 16. So we'll say it's close. I mean, cash and receivables is approaching $2 billion. Okay, it's approaching $2 billion, and their current liabilities is over 4, which means they could use all that cash to pay off half of it, and then they'd have to use an entire year's net income to pay off the other half just for their current liabilities, just current debt, right? So that's one thing where I think they are a little bit too leveraged, and I would like to see some improvement there. But I mean, really, if you look at it like their equity has been growing, let's go to the last 4 years. Their equity has been getting, let's see, what was it? It was, yeah, the equity has been getting better, and it's gone from, let's put it this way, the assets are growing much faster than the liabilities are, and that's what I like to see. And then their net income is still growing. So really, I don't see a huge problem there. How is their, let's see, what's their, if we check Qualtrim, what is their, I want to see what their payout ratio is. Wait, it's not going to tell us here. But I mean, that's another thing. The dividend keeps going up and up. So that's the good part. The payout ratio is 81%. That's a little bit high. And I would like it to be a little bit less. Maybe if it was like 70%, it'd be a little bit healthier, and they could use some of that cash to pay off the debt. That probably be a better option, but I'm sure they want to keep that dividend yield attractive, and that's why they're doing that. But really, I don't want to say this is a bad investment. Let's see. I mean, what's the P is at 19 right now? I don't think this is a bad, especially right here. Look at it. I mean, coming from $175 from $275, I don't think this is a bad investment. I really don't. Especially if investors are looking for a dividend yield in 2025 and interest rates go down, let's say below 3%, this is going to be an attractive investment because this is going to be a solid, consistent dividend that the company continues to grow, and you don't have to worry about them struggling too much. Their margins might go down a little bit, or their, little things. I mean, revenue is only expected to go up 1 or 2%, but as far as consistency and just limiting risk while receiving a dividend, this is a great player for that. And the PE is not high. I don't think you're going to lose a lot of money on the stock price. I mean, yeah, at this point, $175. It's not like they're not going backwards. They're not losing money, or the revenue's not going down. So I don't know. This is something I don't know if I'd be interested in the stock right now, but possibly in a couple months from now. I mean, it depends. Depends how the interest rates are. But I don't know. I'm not against this. I'm not against this. If this is something you're looking into, I don't really have too many bad things to say about it. Um, and I mean, it's a low PE ratio and it's consistent. So I'm going to say I understand if somebody wants to invest in this stock. I would probably, personally, for me, I'm going to wait a couple months just to see how some things play out. But really, I don't think it's a bad investment. So thank you for watching, and I will see you in the next video.